With the holiday season upon us last week, we saw drastic slowdowns across the board, but did it change this week? I'll be going over those stats in today's housing market update, as well as the latest economic predictions, making it difficult to see where things are really heading in 2023. And stick around to the end where I'll share with you what these new predictions will mean for your moves in the new year if they play out the way mainstream strategists are pricing the markets. That's all coming up right now. This is your first time to this channel and you want to know everything about living, buying, and selling in Southwest Florida, then subscribe and tap the bell for notifications so you can be the first to know about the current market, latest news, and newest tips to keep you ahead of the curve. I'm Rick Harrison with the Home Sold Guarantee Group at MVP Realty here in Southwest Florida. My team and I are getting calls, emails, and texts every day from people just like you looking for help on making their move to the greater Fort Myers area, and we absolutely love it. Whether you're moving in 9 days or 90 days, give us a call, shoot us a text, send an email, or schedule a Zoom so we can help you figure out exactly what you want and where you want to be. All of our information is in the description below. So as I mentioned, we're looking at whether the seasonal holiday slowdown has continued this week, as well as mainstream strategists' latest predictions for the 2023 economy and housing market. And at the end, I'll be going over what your options will be as buyers and sellers if things play out the way they believe they will over the next year. But first, let's take a look at the local stats, starting off with the southern part of Southwest Florida. So for Cape Coral to Naples, last week we had 409 new listings. This week that increased up 9% to 448. Still not seeing what we were seeing before the holiday season started, but we'll have to see and monitor this trend to see if they do continue this way. But they're not really moving too much right now. Solds went from 437 last week to 571 this week. Again, lagging indicator, that's all homes that were under contract a month or 45 days ago. Pendings went from 461 to 450, down just 3%. And then we also did see price decreases increase up 29% from 292 last week to 377. Again, all of these stats are pretty mild. Again, everything really slowed down when we started to go into the holiday season. Latest inventory breakdown. Last week we had 5222 for single families. We're down 3 to 5119. Not a huge decrease, so it's really hovering right around where we've been. Last week for condos, 2536 to 2496. This week, that's down 40. So we had a net gain of 47 last week. We have a net loss of 43 this week. So really, we're just kind of teetering back and forth, and we're going to see that theme really playing throughout all the stats and even some of the stories. Multifamilies, 152 last week, 147 this week, down 5. Foreclosures, again, no change. That's like 5 or 6 weeks in a row now with no changes in the foreclosures. Punta Gorda to Sarasota, new listings went from 786 last week to 841 this week. That's up 6, so that's good news there. But we also see that that is not reflective of what's going on in the inventory. Solds went from 1148 last week to 1360 this week. Again, lagging indicator, that's up 18%. Pendings went from 917 to 919. Really not any change there. It was like a 0.1 of a percentage point. And then we also had the price decreases went from 940 to 891. That's actually down 5% for this area. Inventory breakdown. We went from 4285 last week with single families to 4193. That's down 92 units. So that is a fairly significant change week over week. Condos went from 1861 to 1831. That's down 30. We had a net gain of 53 last week, a net loss of 122 this week. So this area did see a little bit more of a change, but still not anything too drastic. We've been making, net gains for the last couple months now in both north and southern parts of Southwest Florida for inventory. Multifamilies went from 57 to 59, up 2, and foreclosures again also did not change week over week in this area as well. Mortgage interest rates as of today went from 6.316 last week to 6.55 this week, according to NerdWallet. Bank rate had it going from 6.57 to 6.66. That's up 9 basis points. So we are seeing both places do have the average interest rates right around 6.5% or a little bit higher. And those have started to move up slightly over the last week or so. But they've really been teetering back and forth, which we'll be getting into. So right now we're going to go into what's the scoop bond market update real quick. I just want to show you what is going on with the bond market. So as you can see, I've had these lines drawn for a couple of weeks now, and I went over the double top with the descending wedge. We did get the breakout that I was expecting, and it has been teetering and hovering right on the line that I put in there. As I mentioned last week's update, we really don't know whether this line is going to become support or resistance. If it becomes resistance, that means the rates will head lower. If it becomes support, that means they will bounce and run higher. So right now, we're kind of in a waiting pattern. We're not really sure where things are going. Everything's kind of hovering, whether that's the inventory and the trends in the market data, or it's actually the economy, the stock market, and the stories that are coming out. You're going to see that theme, like I said, play out over and over again today. With the first story, we're looking at the Treasury Strategist. So this is what I was mentioning right in the beginning in the intro. Strategists are expecting lower yields in the bond market, a steeper curve in 2023. So the most bullish forecasts right now among those published anticipate that the Federal Reserve will cut its overnight benchmark in 2024. So with that in mind, we're really looking at things not really getting going for buyers, or at least in the mortgage interest rates area, until late 2023, even early 2024. So that's one thing to keep in mind if you are a buyer on the sideline right now and you're hoping for interest rates to come down. This is just a prediction, and these are analysts and strategists, which a lot of times are not correct. So, take it with a grain of salt. Bank of America's analyst is saying the rates will likely be headed lower, though the move will require further labor market softening and may not occur until later in 2023. It's a little bit more of a bullish prediction. Some of the more bearish predictions, Citigroup here, there's a scope for treasuries to cheapen initially before a second half rally takes 10-year yield back to 3.25% at year end. So everybody's really putting this into the second half of the year. So it may be several months, according to these predictions, before mortgage interest rates will start to decline again. They do feel in the short term it will be heading higher. So like I said, we'll have to look at that bond market and see if that line becomes resistance or support. All right, the second story here is the New Year standoffs and price dips predicted for the housing market in 2023. This is a Bloomberg story. So a housing market cool down is expected in 2023, but prices will remain higher than before the coronavirus pandemic started, which is what we've kind of been seeing right now. As I'll talk about a little bit later on, we've had in the last 2 years, prices in our area, Southwest Florida, have almost increased 40% with home appreciation. So for it to cool down, it's going to need a lot to get back to those levels that we were at before the shutdown. Sellers may need to be more patient as homes potentially take longer to sell. We talked about that last week. Homes are sitting now for an average of at least 30 days. But kind of to put everything in perspective, the predicted 8% fall that they're calling for in housing prices, according to the bank's home director, such a fall would place the average property price back at roughly the level it was in April of 2021. So that's only going to reverse some of the gains made during the last two and a half years. Some of the things that are affecting the market and will be playing into the slowdown, one, obviously surging living costs, inflation rate right now, obviously, for a lot of things. And then expectations that unemployment will also rise will add to the challenges the housing market faces. So that is something that the Fed is actively trying to produce. So they want more and more people to be laid off. They want to create that in turn will hopefully bring down inflation, though we'll have to see if that actually happens. Continued lack of homes for buyers to choose from is expected to continue to support housing prices. So that, again, is another factor that they're looking into. Pressures on personal finance and mortgage rates stabilizing at higher rate will impact overall affordability in the market. Last couple notes here. Though many buyers will feel the pinch of stretched affordability and will try to negotiate hard for the home they want, sellers may not be in a rush to meet their expectations and will feel like they can hold out for the price they want, particularly if they don't see much competition from other sellers in their area. Now, as I've said, we've been seeing a little bit of a slowdown in some of the inventory coming on the market. It's really kind of hovering. If that continues and we don't see as much inventory on the market, it may be more competitive for buyers, despite how many buyers are in the market or entering the market. There will also be less urgency in the market as buyers wait for the right home to become available for their needs, leading to homes taking longer to sell. and we could see return to the more normal time to find a buyer of around 60 days. So that's really what we would see in a balanced market, which is about 6 months of inventory, which is where we're at right now in Southwest Florida. Last week, if you go to last week's market update, you can see the stats, and we've been hovering over the last 2 to 3 months. We've been right around a 6 month inventory, active inventory on the market. So this is really causing a bit of a stalemate between buyers and sellers, which is not a bad thing. It's a more balanced market. The bad things about this market are the affordability of homes. But I think that's in a roundabout way a good thing, because it's not creating this really high demand and driving home prices up even higher as they have been over the last couple of years. The third story, real quickly, is the U.S. Is in recession by any definition, according to Michael Burry. If you've been watching this channel for a while, you know I'm a fan of Michael Burry. He has his own way of doing things, and I guess he's on Twitter now to stay. He's not taking and deleting his tweets anymore. But this is his latest tweet as of yesterday. Inflation peaked, but it is not the last peak of this cycle. We're likely to see CPI lower, possibly negative in the second half of 2023, and the U.S. in recession by any definition. Fed will cut and government will stimulate, and we will have another inflation spike. It's not hard. He's also calling for the Fed to pivot. Again, it sounds like he's also looking into the second half of 2023. So for you buyers, again, that's something that you're going to have to keep in mind. It may be a little while longer before you start seeing mortgage rates enter anywhere near what you're hoping to get. Keep that in mind as you make your plans for what your moves will be over the next 6 to 12 months. So based on the latest predictions and sentiment on Wall Street, buyers, it could be a long year ahead waiting for interest rates to come down. And while many analysts feel prices will be coming down, they don't believe the decreases will be substantial. Personally, I don't agree with these price drop averages, and I think they'll be settling somewhere around 15% declines. But keep in mind, prices increased almost 40% in the last 2 years. That still means prices will be higher than they were before the shutdown. As for interest rates, the bond market is what you want to watch and understand it's not directly tied to what the Fed does, but rather what the market does and what the bond market chooses to price into the market. The bond market is way larger than the stock market and is a slow mover, but it will be your best indicator for where rates are headed. As for timing a purchase, it comes down to what's best for you. While I believe prices will come down 15% over the next few months, my wife and I purchased a home a little over a month ago because it had everything we were looking for, was a great price for what it offered, had equity built into it, was affordable, and was at the right time for us. It just made sense. Even though rates are double what they were a year ago when we could have bought, sometimes the timing comes down to your job or pay. Sometimes you just have too much going on or aren't ready to make a move. Whatever it is, you'll know when the timing is right. If you're concerned with interest rates, my advice to you would be this. Ask yourself how long you realistically plan on living in the home. If it's more than 5 years, you can comfortably afford the interest rates and have pretty solid stability in your income, I wouldn't wait. There's no guarantee rates will come down, and if they do, you can always refinance. For you sellers, these new predictions suggest that while you may need to wait a bit longer, you'll still have a slight advantage and may be able to still sell near all-time highs. Make sure to keep up with current market trends and pricing for your area and price slightly ahead of the trends. You can watch this video in the top corner on how to price your home with the market trends if you want to know more. Well, that about covers it for this week's market update. If you got value out of today's video, please hit that like button to let me know. And don't forget to subscribe so you're the first to be notified of the latest data, tips, and happenings in our market. And again, please don't hesitate to reach out for help or questions, as many of you do. Our contact information is in the description below. I hope to see you again next week, but until then, stay safe, stay positive, and more importantly, stay free.